June 10th, 2026. A massive liquidation event just hit the Korean market. Now, don't let our super cute Laurel mascot on the screen fool you. What looks like a total structural market collapse is, in reality, a highly orchestrated mechanical extraction of capital. We're going to break down exactly how this went down in today's explainer. Let's get right into it. Minus 4.52%. That's our opening signal. It's a severe, honestly dramatic drop in the KOSPI index, and it demands our immediate, precise analysis. Let's trace the trajectory of this collapse. The KOSPI opened with a brutal gap lower, slipping right below 7,900. And the sell-off? It was so relentless that it actually triggered a program trading halt, eventually bottoming out near 75.40 before a pretty weak close. But here is the crazy twist. This violent market action wasn't actually about Korea at all. The real catalyst was thousands of miles away, orbiting a totally different sector. The impending SpaceX IPO generated a staggering $250 billion in institutional demand. That's against a target of just $75 billion. Add in the fact that OpenAI submitted a confidential IPO filing overnight, and boom, global portfolio managers suddenly faced a hard allocation deadline. They needed cash, and they needed it immediately. So to generate that massive mountain of cash, institutions rushed to liquidate their largest, most profitable holdings. On the ground in Seoul, this looked like 2.23 trillion won in net foreign selling, and almost all of it was dumped straight from the electrical and electronics sector. This wasn't a panic, you guys. It was a forced, one-time raid for liquidity. So how do we actually know this wasn't real capital flight? Well, we have three major clues. First up, look at short selling. In a genuine market panic, short selling volume spikes, right? But during this brutal drop, short selling volume actually fell. This tells us that foreign investors were just doing hedged repositioning. Basically, they were selling stocks, but buying futures to maintain their overall market exposure while generating that much-needed cash. Moving on to our second clue, which is right in the currency market. Surprisingly, the Korean won actually strengthened to 1,527, all while the US dollar held flat. Now, over the prior weeks, institutions had pushed the won to a 17-year low, buying dollars for those exact SpaceX pre-allocations. So the sudden recovery of the won proves that this specific IPO pressure was finally resolving. And our third clue is the definitive proof. Market breadth. Think about it. The index collapsed by nearly 5%. Yet over a third of all listed stocks actually went up. True capital flight usually drags absolutely everything down with it. This breadth pattern proves the liquidation was incredibly selective and highly targeted. So who exactly were the targets? Just look at the megacaps. Samsung Electronics and SK Hynix took massive hits of roughly 6 to 7.5%. They perfectly matched the IPO liquidation profile, meaning they had high daily liquidity and heavy recent price gains. They took the brunt of the hit simply because they were the most efficient ATMs for portfolio managers who needed cash fast. Now contrast that with the rest of the semiconductor supply chain. Equipment names like Jusong Engineering, PSK, and Test actually surged. They gained anywhere from 3 to over 7% despite all the market chaos. This hard data proves that while the big fab stocks fell just to act as cash machines, the underlying investment and capacity expansion in the broader semiconductor cycle remains incredibly robust. We also have to note that the afternoon selling was accelerated by two macro catalysts. First up, geopolitics. Right before the open, a U.S. Army Apache was shot down over the Strait of Hormuz, which sparked U.S. retaliatory strikes. This added an immediate risk premium to the market. But at the same time, it pushed defense manufacturers like Hanwha Aerospace and Hyundai Rotem higher, based on procurement expectations. Second, dual inflation pressures totally squeezed the market. A hotter-than-expected producer price index out of Japan spread rate hike fears right as the market was bracing for the U.S. consumer price index release. Basically, these dual pressures compressed risk appetite from both sides, throwing serious fuel on the afternoon fire. So what's the big takeaway here? Next time the market bleeds, ask yourself, are the fundamentals actually breaking down, or is someone just liquidating your sector to go buy a rocket company? If you would like to receive news on the closing of Asian stock markets before the New York stock market opens, please subscribe.